Since I have Uber rated as my top stock to buy in 2025, I've gotten a lot of investors asking me what I thought about Grab Holdings, which is a similar company operating primarily in Southeast Asia. So that's what I'll do in this video is give my analysis and opinion on Grab Holdings, looking at the company's revenue growth, its profit margin, its cash flow from operations, and then comparing that against its valuation. I did a discounted cash flow valuation on Grab Holdings, and I'll share with you my intrinsic value per share according to that calculation. And then I also looked at the valuation on a forward price to earnings and price to free cash flow basis. I'll bring that all together and give you my recommendation whether I think this stock is a buy, hold, or a sell at current prices. Let's start with revenue.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Grab Holdings revenue growth has decelerated in recent years, although it's still solid, generating double-digit revenue growth, 17% to be precise in the most recent quarter. And given the expansion of the market opportunity and its push into financial technology services, given the markets that it operates in, the Southeast Asian markets are growing faster than the United States and more developed economies, Grab Holdings has strong revenue growth prospects for several years ahead. Although the regulatory environment could make it a little more challenging for Grab Holdings, still, I think the opportunity is large enough where Grab Holdings can continue making inroads in this market. What I've liked about the company is not just the growth, but that the growth is turning into improvements in profitability. The operating margin came in at negative 2%, but that's a big improvement from around negative 300% where the company was at in 2022. The management team has made it a priority to focus on profitability, reducing incentives for drivers and customers so that the company can generate better margins. Industry-wide, that's been the trend over the last 5 years or so, is lessening incentives for nearly every participant in this category. Whether you look at the Southeast Asian companies or you look at the companies operating in the United States like DoorDash, Lyft, and Uber, they've been decreasing incentives that they offer buyers and decreasing incentives that they offer drivers. And all that has worked to improve profitability for the industry. If you've read my book already, the 6-step framework for evaluating publicly traded companies, one of the more critical steps in my investing framework is competition. And if I'm looking at an industry where competition is intensifying, I try to avoid those industries. That's why I've been so negative on the electric vehicle industry. Well, one of many reasons is because the competition in that industry is so intense and it's getting worse. Everyone is cutting, slashing prices, increasing supply, and profit margins are falling industry-wide, and almost every company is losing money on electric vehicles. There's like less than a dozen companies that are generating profits in that industry out of the myriad of companies that emerged in that industry. It's the opposite for the food delivery and ride-hailing services. Everyone has been lowering incentives and raising prices, which has been great news for industry profitability. You can see this kind of uptrend for almost every company that operates in that industry over these last few years. The company's cash flow from operations to sales is much better than the operating income at 30%, and it's also improved significantly. The biggest difference between cash flow from operations and operating income are non-cash expenses like stock-based compensation. I'm okay with companies using stock-based compensation in their early days to generate cash flow and pay their employees in stock, which incentivizes employees more so than if you pay them just straight cash payments. It makes them more interested in the company's success, and it lowers the riskiness of a growth company when they're generating strong cash flow, even if they're losing money on the bottom line because what matters is cash. If you're generating positive cash flow, you don't need to go to investors and ask for more money. That's why cash flow is so important, is it makes your business self-sustainable without needing to go to investors, because there might be moments where you're desperately in need of cash, and at that precise moment lenders and equity market participants ask for really high interest rates to give you money. And if you borrow money with those prohibitively high interest rates, it could doom your business to failure, because now you have these very high interest costs wearing down your business, which is already difficult to grow a new business in this challenging market. So let's look at valuation now. Grab Holdings is trading at a forward price to earnings of 43 and a price to free cash flow of 25. This is near the lower end of where this stock has traded for in the last 3 years, according to these metrics. Now, these are reasonable metrics for a company that is expanding revenue at double digits while simultaneously generating very healthy cash flow from operations and improving those metrics and improving profitability in an industry where competition is becoming more favorable and in an industry that has a massive total addressable market, all of which are great indicators of a company's future success. I also did a discounted cash flow valuation for Grab Holdings. For channel members, they have access to these spreadsheets, and the intrinsic value per share I calculated was $5.61 for Grab Holdings. The current market price is $4.54. So even accounting for a reasonable 10% margin of safety, Grab Holding stock looks undervalued, whether I'm using the discounted cash flow approach or whether I'm using the price to earnings or price to free cash flow approach. So to answer the question, is Grab Holding stock a buy, hold, or a sell? I would say Grab Holding stock is a buy at current prices. Of course, risks remain and you should do your own due diligence, but according to my analysis and my rankings of the company's characteristics, I have it rated as a buy in my categories. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.